Common Trading Mistakes, Trader Chang. Hello everyone, welcome back to Trader Chang. In trading, strategy is important. But in reality, the thing that determines whether you survive long-term in the market is your mindset and trading psychology. Many traders spend hours searching for setups, learning indicators, and chasing new strategies. Yet they ignore the one thing that impacts their account the most: emotions. In today's video, we're going to talk about the 3 most common psychological mistakes that almost every trader experiences. And especially, the final mistake is the one that causes many traders to lose money consistently over a long period of time without even realizing it. More importantly, I'll share the exact methods that I personally use to improve my trading psychology in a simple and practical way. At Trader Chang, we focus on real trading experience, simple concepts, and habits that help traders grow consistently. Alright, let's get started. 1. FOMO, fear of missing out. FOMO happens when you feel like you cannot miss a trading opportunity. You see the market moving aggressively. You see other people posting profits. You see signal groups calling a perfect setup. And then you start thinking, this is the trade that could grow my account fast. FOMO usually affects newer traders the most. When you don't have enough market experience yet, it's very easy to get pulled into emotions and become influenced by what other people are doing. You watch a strong move happen without you. Then you regret missing it. And you tell yourself, next time I have to get in. That mindset slowly pushes you into emotional trading. You begin entering every setup that looks good. You increase your position size because you believe, if this opportunity is so good, why not go bigger and make more money? But the problem is, nobody knows exactly where the market will go next. And once the trade moves against you, all the excitement and confidence disappear. You start losing money. You panic. You blame the signal provider. You search for someone else to recover your account. But the truth is, no one is responsible for your trades except you. How to overcome FOMO. One of the first things I personally did was leave noisy trading groups, especially groups that constantly spam signals, show profits, or create emotional pressure. When your brain absorbs too much information nonstop, you lose the ability to think independently. Trading is not about chasing every opportunity. Trading is about waiting for the right opportunity. The market will always create new setups. If you miss one today, another one will come tomorrow. What you truly need is not someone else's signal. What you need is a clear trading system that helps you make your own decisions. Focus on building your own knowledge and experience. Other people's analysis should only be used as reference. Never treat it like a life jacket. 2. Revenge trading. This is one of the fastest ways to blow up a trading account. After a series of losing trades, many traders completely lose emotional control. At that point, they no longer care about risk management. They no longer care about strategy. The only thing they think about is, I need to make my money back. And that's when everything becomes dangerous. Traders begin overtrading, increasing lot sizes, doubling down after losses, trying to recover losses quickly. Sometimes this works once or twice, and that temporary success creates false confidence. But over the long run, this behavior almost always leads to disaster. The real cause, the biggest reason behind revenge trading is simple: You are allowing money to control your emotions. When the loss becomes too painful, your brain enters a state where it wants revenge. The more emotional you become, the more trades you take. The more trades you take, the more control you lose. And eventually, the account gets destroyed. What helped me personally? Instead of depositing your entire trading capital into one account, divide your capital into smaller portions. For example, if your total trading capital is $1,000, don't deposit all $1,000 into the account. Only deposit a small amount that is enough for a few trades. This helps protect you from emotional decisions. If you lose and want to continue trading, you'll need to manually deposit more money. That short pause often helps you calm down and think more clearly instead of revenge trading emotionally. Another important thing, start with small position sizes. A trade risking $10 feels completely different from a trade risking $1,000. When the risk is small, you focus more on logic and execution. But when the money becomes too large, emotions begin controlling your decisions. Train yourself to follow the process first. Profits will come later. 3. Taking profits too early, holding losses too long. This is one of the most common habits that causes traders to lose consistently over time. When trades are winning, traders close them too early. When trades are losing, traders hold them too long. Why does this happen? Because human beings naturally hate losing money. When a trade goes negative, you don't want to close the loss, because closing the trade means accepting that you were wrong. So instead, you start hoping the market will come back. And sometimes it actually does. That small success trains your brain to repeat the same bad habit again and again. Until one day the market keeps moving further against you. That's when traders begin holding losing positions, adding more money, hoping for a reversal. And eventually emotions take full control. But when the trade is profitable, you become afraid of losing those profits. So the moment the market pulls back slightly, you close the trade too early. The result is winning trades make small profits. Losing trades create huge losses. Over time, the small wins cannot cover the large losses. How to build better trading habits. The first thing you should do is always set your take profit and stop loss before entering a trade. At the beginning, you don't need huge profit targets. Simply set your TP and SL at the same distance. Practice this using a demo account or very small position sizes. After entering a trade, set your TP, set your SL, and let the market do the rest. Stop staring at the chart every minute. Stop changing your trade emotionally. Practice this consistently for a few weeks and allow your brain to develop better habits. At first, you may not make a lot of money, but what you gain is far more valuable than short-term profits. A strong trading mindset. Once you remove bad habits, your trading performance becomes much more stable. Final thoughts. Trading is not only about analyzing charts. It's a game of psychology, patience, and emotional control. Mistakes like FOMO, revenge trading, taking profits too early while holding losses too long, are things that almost every trader will experience. The important thing is not whether you make mistakes. The important thing is whether you recognize them and improve from them. Treat every mistake as a lesson that helps you grow into a stronger trader. If you found this video helpful, make sure to subscribe to Trader Chang so you don't miss future trading content. Wishing everyone safe and successful trading.